Hello everyone, this is Paul from the APN Academy and hope we're all doing well. So this is the last video of the beginner series and we're going to be combining everything that we have studied in the past 13 videos and then we do them practical. We're going to have a lot of practice in this video and hope you guys are going to be ready with your books and pens, or you're going to be ready with your computer so that you can backtest whatever we're going to be speaking about, right? So without wasting any time, what are we going to be covering in this video? We're going to be covering price action trading strategies that you can be using. I hate the word strategies, but I just have to use it because it's what everyone likes using, but I'm not a fan of the word strategies, right? So I'm going to be looking at these price action methods that you can use to start trading, right? And under here, we're going to be covering majorly two things. One, the structures we're going to be looking out for, and then their rules. Remember, everything that you're going to be finding in the markets or on the charts has its rules, right? Then number two, we're going to be looking at how to take entries and then manage the trade and exits for those particular structures that we have looked out for. Remember, I've said we're starting with structures that we're going to be looking out for to trade. Without these structures, please do not take any trade. Are we together? Then secondly, we are going to be looking at how we can take entries and then manage the trade and then up to the exit point, right? Then let's start with which structure we're going to be looking out for. One, we're going to be looking at trending markets. Now, remember during the previous videos we have been talking about trending or trends. Now, we said we have the market can be trending in two ways. One, it can be trending upwards in an uptrend. When the market is an uptrend, we're making higher highs. We first make a high, we make a low, we make a higher high, then we make a higher low, right? Now, when the market is moving in such a way, of course, it's not as perfect as this. I've mentioned this a couple of times in the previous videos. The market does not move as smooth as this. And it cannot just move as smooth as this because price in this high here that the price is making, there are a lot of inner movements also it's making, right? So it's not going to be as smooth as this. So this is just for learning purpose. But when you go on the chart, I'm also going to show you perfectly how you can mark this high, you can mark this higher high, you can mark the higher lows and higher and the coming higher highs, right? So someone should not say that, hey, why are you marking like this? But when I go to the chart, I'm seeing something different. It's because this is just for learning purposes. But as usual, we start with theory, then we get to the practical bit of it. So make sure you sit tight until we get the practical bit of it so that you can see all these things as we illustrate them, right, on the charts. So this is an uptrend. In a downtrend, we shall be making lows high. We first make a low, we make a high, then we make a lower low. Now, a lower low, why is it a lower low? Because it is lower than this previous low that the market has created. And I mentioned that when the market makes a lower low, it has to come back and retest the broken low, the previous low, now which has become a resistance. Previously, it was support, but now it has become a resistance. So when a resistance is tested and the market continues making new lows, new lower lows, right? This is what we call a down. We call this a downtrend. Then this one whereby the market is making higher highs and higher lows, we call it an uptrend. So one of the structures you're going to be looking out for are trending markets. So you have to first identify, where is the market trending? Is it trending upwards or is it trending downwards? So that you can know where to take your trade from. Now, let's just slightly go in deep depth about these two, right? Now, let's start with an uptrend. Now, uptrend, we're looking for buys. So when the market creates this high and then creates this low here, remember we said when the market breaks this high here, this becomes a support. Before it was a resistance, but it becomes a support. Now, when the market breaks, we expect it to come back and retest here. I do not expect you as a beginner to start trading these reversals here. You can trade them, yes, but with time, when you get experience. We have a lot of videos that speak about trading reversals or pullbacks, but for a beginner, I would not advise you to trade reversals. Trade with the trend. So meaning that what is going to be your point of interest or your area of interest where you're going to be taking the trade from? You're going to be wanting to take the trade when it comes back here. Please be patient. I'm sure you've heard that trading is all about patience. So you're not interested in this trade until it comes back here. Are we together? So this will be your area of interest whereby you're going to be looking to take trades from, to take more buys. Then again, when the price breaks up this high that it had created here, if you had, in case you had missed this trade, we're interested in taking the trade when it comes back here. So we're looking for buys until the market stops making these higher highs and higher lows. Are we together? This is for an uptrend. Then for a downtrend, it's just the opposite. When the market prints a low, prints a high, and then breaks below. Now, this part which was acting as a support is now acting as a resistance. So we're not interested in taking these sales. until the market comes back in this point here. So when price comes back in this point, this is our area of interest, or what we call area of value. So we shall be looking for take our trades from this point here, right? We're also going to be speaking about targets when we go to the practical bit of it. Now, when you take yourself from here, again, when the price breaks here, in case you missed this trade, you're going to have to wait for the price to come back to this previous support, which is now resistance. So when it comes back in here, this is what we call our area of interest or area of value. Then you can take your trades from there. Please, as a beginner, do not trade these pullbacks. These are called pullbacks or retests. Do not trade them because they take a lot of expertise, right? They seem simple, but most people are actually losing money because of trading them. How can you avoid that? Or how can you be able to being conservative is not nice to some people, but actually that's how you can keep your money, and then you make more money as you're keeping your capital. It's not good to always keep depositing money, right? So those are some of the things you need to avoid: trading against the trend. Are we together? Remember, this is just theory. Stick around until you get the practical bit of it. You're going to see actually how we apply this, right? Now, that's about the trending market. Now, the second thing we're going to be looking at are impulses. Now, impulses, you can call them impulses or aggressive markets or aggressive movements in the market. Now, remember, we have said in trending markets, the market is breaking while retesting. It's breaking while retesting, breaking while retesting, right? Or when it's going down, breaks, retests, breaks, retests. Now, you're going to meet a scenario in the market, or if you've been trading, you're going to meet a scenario in the market whereby the market will create a high, create a low, right? This high here. Then the market will break and continue up and will not retest. Now, this is what we're calling an impulsive market or an aggressive market. Are we together? This is what we're calling an impulsive market or aggressive market. So also you can trade this, and I'm going to introduce to you a tool here we call the Fibonacci retracement tool. Now, we have a whole video about it, a full video about it. Here I'm not going to speak about it in depth, but I'm going to show you how you can use it. Then after this video, you can go and watch that Fibonacci retracement tool in depth so that you can apply it correctly. Though we are going to also look at it here. So for you to apply the Fibonacci, the first rule is that the market has to first be in an impulsive movement. It has to be an aggressive movement. By aggressive, I mean that the market has broken a point and it has continued moving up, like by several candles without retesting this area. Now, the market makers or liquidity providers know that if we are to come back and retest this area, we are going to pick up very many traders who are waiting for us here, because most of the traders know that if we have broken this high and we have gone up, we expect to come back here. Now, you're going to observe when you go to the chart that when the market makes an impulsive market, it doesn't come back here, but rather stops somewhere up here and then continues up. Let me just clear this so I show it properly. I was saying that when the market makes this impulse, and you draw your fib, it makes this impulse. Sometimes we expect it to come back here, but it doesn't. Rather, it will come and then it will stop somewhere here and then it continues up. What causes that is because of this impulse. And here in this scenario, we have to apply what we call the Fibonacci retracement tool. Are we together? Now, how do we draw the fib tool? The fib tool is not an indicator. Most people tend to confuse it to be an indicator, but it's just a tool, just like the diagonal lines, the horizontal lines, and other tools that are provided to you on the MetaTraders or your different trading platforms. So you can simply just add it to your functions. You can put it amongst the tools that you use, right? You can add it. And then how do you draw it? You drag it. If this is an impulsive move from up, you drag it from down up to up. You're drawing it from left to right, right? Meaning you start from where the impulse started from, right? Then you drag it until where the impulse stopped, until where sellers came in from. The impulse is for buying, right? So you drag it until from where the buyers came into the market until where the sellers came into the market. That's what we call the impulse, where the impulse stopped. Then the impulsive sell is just the opposite of this one. If the market was making a lower high and then makes an impulsive move, still you're going to draw it from where the sellers came into the market until where buyers come into the market at this point here, because we want to know where the market or the price is going to bounce off from. So now what are we going to do? You're going to also draw it from left to right. This is your left. You're going to drag it from up to down here, meaning that your 100 point is going to be up, and then the 0 is going to be down. Here the 100 is going to be down, the 0 is going to be up. We're going to do this practically on the charts, right? So this is the second structure that we're going to be looking out for as a trader. When you're trading, you need to know what you're looking out for in the market. Most people go in the market not knowing exactly what they're looking for. So this is the second one we're looking out for. The first one is trending markets, where we're making higher highs and higher lows. We want the market to come back to the broken level, then we go up with it, or we want the market to come back to the broken level, then we go down with it, depending on the direction in which the market or the price is trending. Now, the second one I was spoken about is the impulse, whereby we need to apply the Fibonacci retracement tool. Then which one is the third one? Now, the third one is the W's and M's. We have a whole video about this, but we're going to just speak about them quickly for us to understand. Now, a W, this is not a W, guys. Most traders get caught here like this. This is not a W. Yes, it can be a W on your alphabetical chart, but this is not a W in trading, or this is not an M in trading. It's an M on the alphabetical charts, but not in trading. Are we together? Now, which one is the correct type of W or M? The W, this middle part here is what we call a neckline. This middle part is what we call a neckline. Now, in trading, of course, all these are made up of turning points. We've spoken about this several times in our previous videos. I think in all the 13 videos I've been doing, I've been speaking about turning points, how important they are, how everything in trading comes about them. Shapes come from there, patterns come from turning points, and everything. So also this middle part is made up of turning points. Even these shapes, the W's and M's, are made up of turning points. So now, why am I saying that these are not W's? Why is this one not a W? Why is this one not an M? It's because this neckline is not being broken. The moment it's not broken, it's not, because of the following reasons. One, when a W is made and the neckline is broken, we expect price to come back and retest this neckline. Are we together? Just like in a trending market, when the market, because these shapes are telling us that if the market was going down, these shapes give us an indication that this price is no longer continuing down. Or if the price was going up and then we make an M, it's indicating to you that the price is no longer interested in continuing up. So in other words, they help us to determine when the price is changing direction, what we call change of trend. So there cannot be change of trend when the neckline has not been broken. That's why we're saying that this one's down here, this one is not a W, because the neckline wasn't broken. Why? Because the market can stop here. This turning point is acting as a strong level of resistance. The market can stop and then it continues down. What was looking like a W now becomes an M. Most traders get affected by this. The same applies here. Since this neckline is not broken, and you just gamble around, or you assume that the market has made an M, you sell and the market makes a W. What was looking like an M before now becomes a W. Are we together? So what are the rules of trading an M? The first one is the neckline has to be broken. This neckline has to be broken. Then we shall expect a retest. So also the same as trending markets. When the market goes up, now for W's and M's, you can decide either you want to trade this retracement here, or you want to trade the continuation, because we expect the retest and then the market continues up. Now we expect the following outcomes. When there's a W and there's a retest of the neckline, we expect a higher high, or when there's a retest of the neckline, we expect what we call double tops, or we can expect a higher low, sorry, a lower high, right? The same applies for an M. The rules are just the same, because an M is the opposite of a W. When there's an M, we expect that the neckline is broken. We shall expect it to be retested and then a low, or we can expect double bottoms, right? Or we can expect a higher low. Are we together? These are the three outcomes of these shapes. Now, we also have a full video about the W's and M's. So immediately after this video, make sure you go and watch it in depth so that you understand everything in detail. Now, these are the structures that you have to look out for as a trader. Are we together? Now, if you don't see these things, make sure you backtest them, master them, and they're the only things that you need to be looking out for when you're trading. Are we together? So without wasting time, let's just go on. Okay, so we're going to use an example on gold, and we're going to try to look out for all these structures that we have looked at that you can be able to use to take trades, right? Remember, you have to first see those structures that were spoken about. One, either you're in a trending market. Two, you've seen W's and M's, or you've seen an impulsive move. So we're going to try to identify all this. We're going to try to look out for one or two examples in each scenario, and then we can use it to take trades so that you can see whatever we've been covering the previous 13 videos. Are we together? Of course, we're going to keep on releasing videos that will help you with proper examples of entries and how you can take your exits, right? Now, I'm just going to replay this. We're going to choose anywhere. I don't know where we should start from, either here Oh yeah, let me just pick let's say this point here, right? So let me just increase the size so that we can see it properly. Now, when we start from here, we can clearly see that the market created for us this M, right? And then plus an impulse. Now, remember we said an impulse is when the market creates for us an aggressive move down. You can clearly see this is daily, but for 3 days, 1, 2, 3, the market was just selling. So this is an aggressive move. It means that the presence of sellers were too strong in the market. Are we together? So let me just clear this. Now, before we start even looking at our examples, as a trader, you have to have 3 types of time frames. The first time frame is where you're doing the direction from, right? You get your direction from. Are we together? Then the second one is where you get your structure. From the structure you're going to trade. Then the third one is where you're going to take your entry from. Then the fourth one, which most traders do not usually consider, so that's why I said 3. But the third one is also important, whereby you do your refining from. Are we together? The fourth one helps you to do refining. We're going to cover all these in the upcoming videos, but for this particular one, we are focusing on the structure. Are we together? So you first get the direction, the overall direction of where the price is heading. Then secondly, you're looking at the structure to trade. Now here we're looking at structure to trade. We're looking at what can give us a trade. Then after getting what can give you a trade, then you can look for the entry. All these things have to be considered before you take a trade. That's why you'll see someone saying, I saw this and went against me. I saw this and didn't play out. I've been doing this, but it's not working out. It's because you're not considering all these things. Are we together? We also have a video that speaks about the importance of time frames. You can use it, but still we're going to speak about these aspects in the upcoming videos, right? So let's continue. Now, let's say this is an impulsive price movement here. So what are we going to do? We're going to bring our fib tool, and then we are going to drag from left to right up to where buyers came to the market. Now, someone is going to say, why are you considering this as a place where buyers came into the market? It's because there's a rejection here. Let's try to play and we see if that's the point actually where buyers came in. Yes, this is the point buyers came in. So I'm interested in the fib levels, this one. I'm also interested in this one, and I'm interested in the 61. But for now, let's just mark those 2, right? And we see exactly where price is going to stop. So you can clearly see we have a price rejecting here. Now, when we see price rejecting here, what are we going to do? We are going to now shift to our entry time frame. Are we together? Remember, we said we are going to be looking at how to take entries and also our exits. Now, before we go to the entry part, when you're taking entries, you're going to consider the same things. You're going to look at the candlestick patterns that we talked about in the previous video. That's 1. Then 2, we're going to also be considering these shapes, the W's and M's. I've given you briefly the rules of M's and W's. And also, you're going to be looking at higher highs and higher lows. Remember, we say that when the market is moving up, we're making higher highs and higher lows. And then when it is to shift to start moving down, it has to stop making higher highs and higher lows to start making lower lows and lower highs. So those are the things we're going to be looking at to take our entries. So now I'm just going to mark this point here. Now let's just shift to H1 so that we can look for a trade, right? So now we do have a market that was making higher high, higher low, higher high, equal lows almost. Okay, this is a higher low, higher high, higher low, higher high. Now the market is trying to break below, but this is not yet, it has not yet broken below completely. So let's just see how the market moves. So we're looking for a change of trend. Let's just see if the market gives us that change of trend. It failed. Now, the first time the market comes and communicates to us that, hey, I'm not interested in continuing up is this point here, right? So here someone can decide to refine, but I want to just use H1 because it's one of my favorites entry timeframes for intraday. But if you want, you can refine it further. I don't want to bring in that aspect because it will a bit confuse us. Now, this is the first time the market communicates to you that, hey, I'm not interested in continuing up, right? So when we continue down there, you can clearly see the market tries again to go up, but it's rejected, right? So let's see if it continues up. Still, this price level holds it, right? The price fails to break above. Let's see if it continues. So price fails to break above this area here, meaning that now is a point that we can take our trade. So when the price breaks below this point here, comes back down to, and also it has made for you, this is what we call a lower a lower high here. And also it has failed to take out this point, making it a double top. So this is where we're going to take our entry from. And then the target, your target is always going to be 1 to 3. We shall explain this in depth when we come to the part of risk management. Now, why 1 to 3? Because we're risking, let's say, $10 to make $30. Now, if you're to calculate that, if let's say you sample, let's say 100 trades or 200 trades, even if you lose many trades and then you win few, you will find out that the wins are always going to cover for those, and even you will surpass the losses. That's how trading is. You're not going to be 100%. You're going to lose here and there, but make sure that when you win, you're winning more than your losses. Are we together? So now, let's just take our 1 to 3. We're going to take a sell. This is our entry here, when to retest it here, and then our stop loss is just going to be above here. We just want a 1 to 3, right? We just want a 1 to 3. Let's see if the market will give us our 1 to 3. This 2, 1 to 3, right? So let's see if really the market will hit our target or it will hit a stop loss. So the market came and missed our target by just a few pips, right? It missed our target by a few pips, but in this case, the market, you will have protected your trade. We're going to be speaking about how you can protect your trades. So I'm going to assume that this one you went break even, right? I'm going to assume that this one it hit, let's say you went break even, right? Now let's go back to daily. That's the first one, the impulse one of using the Fibonacci retracement tool. Now let's go back to the daily time frame where we get our structure from, right? Today we're getting our structure from daily, and then we see the next trade that we can be able to take, right? Remember, we're considering the 3 aspects. We're considering W's and M's, and we're considering impulses, and we're considering trending markets. So when we identify a market starts to trend, then we can take our trade. Right together? So let's continue. Okay, so let me just go back here. So here also the market broke above this structure here, gave us a W plus an impulse. Are you seeing this? 1, 2, 3, 4 days, the market was just going up. Now, when you identify that the market is doing an impulsive movement, what are you going to do? You're going to bring out your fib tool and then you measure until where the sellers start rejecting the market to bring it down. Are we together? So let's see if the market gives us that retracement. All right. So also we have here an area that has a presence of sellers. So this is a strong level of resistance. So this is going to be our point of entry where we're going to be looking for the trade from here. Impulse plus an area of support, then you get a proper confluence, right? So let's go to our area of our time frame of entry, which we're going to use H1, right? We're going to use H1. So as the market is coming down, we want to observe change of trend, right? So let's see. The market is still aggressively coming down, aggressive low, a small presence of buyers. Let's see if we get a change of trend. So the market is still making lower lows, lower highs, lower lows, lower highs. So our area of interest is the market to go above this area here. So let's continue. So we're going to take our trade when the market goes above this area here. We're not interested in taking this trade. That's why we're saying patience is very important in trading. We're not interested in taking this trade unless price goes up here. So you have to wait. You can see how many hours after 1, 2, 3, 4, 5, 6, 7 hours almost. You're just observing the trade, or you've set maybe an alarm or an alert, right? So you can clearly see the level held the price still. We're not interested yet until price breaks above there. You can clearly see it attempts, but it fails. Now, this is the first time price breaks above this area here. Are we together? So if you want, you can refine it, right? You can refine it, but today we're not refining because it's going to confuse you. We shall speak about it in the upcoming video. So we're going to take our trade from here. I'm not going to refine, so I'm going to take a bit from there. It's a bad entry, but just for the purpose of the video, we're not refining it. Let's see if we shall hit stop loss. So as usual, we want a 1, 2. Sorry. As usual, we want a 1, 2, 3. Want a 1, 2, 3. This is a 1 to 1. Okay. 1 to 3 there. So let's see if we shall hit stop loss. Want a 1 to 3 there. So let's play and we see. We almost hit stop loss, but our entry held. So let's see. Okay, here we hit our take profit here. Just this one was a bit quick, I think, the fundamentals, right? So we have hit our take profit. The first trade we hit, it was a break even. I'm assuming that was break even. But of course, in trade management, you either protect your trade or you secure some trades. But I'm assuming that here you didn't make money. Are we together? When you're back testing, make sure that you're considering the worst possible case scenario. So the first one we had an impulse, right? Also, the second one we have a W and an impulse, which we have considered. So let's go back to daily and we see if we can find out other market scenarios. Now, if you can observe, the market is attempting to break above here. Actually, the market closed above here, right? Now, are we starting an uptrend? Let's wait and see. Actually, we made a W, an impulse retest here, but we want to take out, if we take out this area, then we start an uptrend. Are we together? Now, this should remind you of what we mentioned earlier, that what we mentioned, the other side, higher high, higher low, higher high, higher low, higher high, or lower low, lower high, lower low, lower high, lower low, is not the same what you'll see in the market. Now, this is a high in the market. The market made this low. Then this is the swing high, higher low, higher high, equal lows. Now we're attempting to create a new high, right? Which we have not yet created. Are we together? But when you're studying in class or on the boards, right? Theoretically, you're going to see that excuse me, you're going to see that it's smooth like this, but in the market, you can clearly see there are also other inside movements, higher small highs and higher small lows, right? So here we're considering the one that gave the most push either up or the most push either down. We have a video explaining all that. So after this video still, make sure you equip yourself with that. So now let's see if the market will actually close above this area, right? Let's see if the market closes above that area. So the market closes above this area. Now let's go to our entry time frame and observe if the market will give us actually a trade, right? Let's come and observe if actually the market will give us a trade, right? So we want the market to come back in this area so that we can take our trade. Let's see if the market will actually come back. You have to be patient. In case it doesn't come back, you're not interested. Now, you can clearly see the market came back in this area. But now, what are we looking for? This is an aggressive market. Remember, we said, even if you're taking a trade, you're looking for either the market changing from higher highs to making lower lows, or shifting from making lower lows to making higher highs. Now, in this case, the market was so aggressive. Now, what do we want to see? We want to see at least either a pattern. We want to see either a shape, like a W or an M. But this time, those Ws and Ms are not for structure. We're using them for entries. Are we together? No, we're not using them for area of interest to look for where we're taking a trade from, but rather we're using it for area of entry to take our trades. So now let's see if the market actually will give us that structure. The price was a bit aggressive, you can clearly see, but still the area was held. Price was held there. So let's look at where the price, okay, so now we're interested in the price taking out this area here, right? This area where price came, reacted, and was rejected. So let's see if price will take out that area, and that's going to be our entry, right? Before it takes out that area, we're not interested. Are we together? We're not interested before it takes out that area. You can clearly see it rejected the area. Now, this is the first time this area actually was broken. So what are we going to do? We're going to take our long just from here. A 1 to 3. Always your target should be 1 to 3. I've briefly explained that, and then I'll put it below this to be safe. Because we're in an uptrend now, we expect the market to print a new high. So 1 to 3 should work for us. 1 to 3. So let's do 1 to 3. Okay. So let's see if we hit stop loss. If you hit stop loss, it is okay, right? Do not beat yourself that, oh, the trade didn't work for me. If you hit stop loss, it's okay. So let's see if we hit take profit or stop loss. Seems it's going our way. Okay, it came back. In this case, now you can go risk-free. You can either put break even, or you can protect or secure some. That's part of trade management. You can secure some trades or profits that if you had gone with multiple positions, or if you had a few positions, 2 or 1, you can protect a few pips so that you're safe, right? So let's see if we hit our target actually. Okay, a bit too long. Okay. So here we hit the take profit at this point here. Now, this is our second trade. Now, this is our second trade hitting target, but in total we have 3 trades. We have one that was break even. Let's try to look at a case of a downtrend. Remember, we have changed direction now from here. So let's try to look at a case of a downtrend, right? So let's start from up here, where the market changed this trend from here, right? So we are going to identify this is our low that we need the market to break, right? So the market closes below here, we're going to be looking for sales. Are we together? Remember, now the market is not making higher highs, higher lows, higher highs, higher lows. Now it has shifted. Instead, it made this high and has made, this is a high, a higher high, actually. Now we have made a lower high. So now what we want for us to start selling, to start going bearish, what we need the market to break this area, and then we can start looking for sales. So let's see if we break. Now, this is the first time the market closes below this area here. Now, the moment it does that, we're going to go into our entry time frame, which is H1, and then we start looking for our sales. Are we together? So here you can have a counter trend line. We have talked about trend lines. You can have a counter trend line. We have a video amongst the previous 13 videos. We spoke about trend line. So, and your entry can just be here, right? So let's take our short entries just here, and then our stop loss can just be above this area here. Are we together? So as usual, we're taking a 1 to 3. As usual, we're taking a 1 to 3. Okay. Let's see if we shall hit the stop loss for a good entry, or our entry was bad, right? So let me just autoplay it. So we are into the trade. Let me just pause this. So for those who want to take multiple entries, also you can have another entry after the market created this small M and then came back for this retest. You can have another entry here, right? When it came back for this retest here, you can just have another entry here. We can also go for, this time it will be a bit, the stop loss will be, let's put the same stop loss, then the same target. It will be 1 to 3 still. 1 to 3 still. Let's see if we shall hit take profit for the 2 trades, right? So these are the 2 trades that we do have now. We have 2 trades, counter trend line broken. So let's now see if we shall hit our targets. Remember, our first target is this one here. Then the second one is this one. So you have 2 trades running because of the reasons I've given you, how you can take your trade. Now, this is the scenario I was saying that if the market breaks down, retests, breaks down, retests. Now, in this scenario, you can go risk-free. You can go risk-free, or you can protect some trades because there are a number of pips that the market has already moved here. This is a big market, and our capital is just like a drop in an ocean. So make sure you always protect whatever you've made so as you can grow your account and have some withdrawals, right? Now, let's continue. Let's continue and see if we actually hit the take profit for the 2 trades, right? We have 3 types of traders: those who protect, those who do not protect, those who just put stop loss and stay there. So let's see if we hit stop loss. Both our stop losses were missed. So let's see if actually we shall hit stop loss. Let's see if actually we shall hit stop loss. Now, those who had protected are already out, but still you could have gotten into the trade again because we did have a change of trend here again. We had the change of trend when the market created this, and also when the market broke below here. You could have had another entry here. The market broke here and even retested. So if the market had kicked you out, this would be another entry for you here, right? This would be another entry with a 1 to 3 and your stop loss just above here. So we can also go for a 1 to 3 here 1, 2, 3. So let's see if the market will actually take us out. So the other first one, it has already hit your target. This first one here, the market has already hit your target. So we're left with 2 trades that are running. For those who are not protected, those who protected, you only have 1 trade running, right? This is your new entry here that you have running. So you've lost let's say $10 if you're risking $10. And then let's see if you make back the $30, right? Because the rules have been followed, structure is broken, and then it gave us another entry, right? So let's see. Still, again, took those who protected. If you had protected, they still took you out, right? What about those who are using stop loss? Let's see if it hits your stop loss. Still, it misses out your stop loss. Another entry was given for those who were kicked out at break even. There's another entry, but let's just leave it for the purpose of making the video short, right? Let's just leave it for the purpose of making the video short. So will it hit our target? Let's see if it actually hits our target. Sorry. Let's see if it hits our target. So this new trade the target has been hit, right? It's just 1 trade that is left. Let's see if it will hit our target. See if it will hit our target. Okay, so our target was hit here. So we had some break-even trades in the same place, and also we had to retake some trades. Are we together? It happens in trading, but you just have to follow your rules, right? Now in this process, also the market has created a new lower low, lower high, lower low, lower high, lower low, lower high, lower low, right? So on this retest here, still giving us new opportunities to take trades, but the principle is just the same, right? The principle is the same. Make sure you apply the same principles, the same rules that I've given you. We have videos in depth of all those rules. We have videos in depth of trend lines, in depth of W's and M's, and also impulses. So make sure after this video, you go and watch them in depth. This one is just beginners videos, the last video of beginner series. So I could show you how you could look out for these structures in the live market so that you can be able to trade them, look for entries, and also manage your trades, applying exactly what we did in the previous 13 videos. So this is the last video of the beginner series. I hope you guys really now know what Forex trading is, and it makes sense to you. Now you can now start following the new videos that we shall start uploading, or even the previous ones, so that trading can make sense for you, and you can also become a pro, right? It's going to take time. So you're not going to become good just overnight. It's going to take time, but you need to put in work. For you to become good fast, you need to put in a lot of work. Remember, do not go on a live account or do not invest your money before you understand exactly what you're doing. How are you going to understand that? You're going to understand it by practicing. You can backtest. There are very many other platforms. My favorite is TradingView. Even you can backtest on your MetaTraders. Those who are not covered with TradingView, you can use your MetaTrader, right? It doesn't have a replay tool yet, but you can just backtest. Just look for M's, W's, and take back in time, do your charts and see what happened. Did it follow the rules that we spoke about here? And then also go to entry time frames and see how would you take the trade, right? Make sure you backtest so that you become comfortable. Do not cram all these things. Just master a few things in trading, then you'll become good, right? So if it was your first time coming across our videos, make sure you hit that subscribe button and turn on the notification bell so you don't miss the upcoming videos. And then if you've been watching and made value, or it made sense to you, you found value in it, you found sense in the video, make sure you click the likes button for also others to come across it. Have a great time.